Thumbs up when we're live. Oh, I think we're live now. All right. Good morning, everyone, and welcome to our COR Tax and Bookkeeping Wednesday webinar. Um, Today we are going to be talking about, Casey, what are we going to talk about today? What's the topics today?
Reconciliation and what profit and loss.
Very good. I think we're going to talk about good debt and bad debt today
Yes.
too, right? That was one of the things we talked about,
Yes.
debt, bad debt.
Yes.
Awesome. Very good. All right. Well, if you have any questions and you are watching us on any of the live streams, you can post your questions in the comments. You can post them in the chat here in the Zoom. You can submit them through the Q&A. And Sam and Casey will pick them up so that we can answer your specific questions. But I know that we already have some questions from our community that we are going to be walking through. So let's see. Casey, you want to get us, or I think Sam, you were getting us started today, right?
Yes. Yes.
Right. So Sam, if you want to get us started with the first round of questions, we will get this show going.
Yes. All right. So, actually, we've been reviewing financials for the past few years and with a lot of clients, and we've noticed that many business owners aren't totally sure what's reconciliation actually means. So, can you give our audience some explanation on what it really is and why it's so important?
Absolutely. Absolutely. Okay, so reconciliation is the process of um, essentially making sure that one data set matches to another data set, right? So we've got like a master set that is providing us what actual information is, and then we have another data set that we want to make sure matches it. And so that's really the process of reconciling, is making sure that the two sets of data match each other. Um, and what that means in accounting is that we're looking at bank accounts, we're looking at credit card accounts, we're looking at loan accounts, and we're making sure that the transactional data and information that the banks have is the same as what we have in your QuickBooks file. And so that's really where that comes into play. Um, 1 second, I'm going to share my screen with you guys so that we can look at this sample company together. And we could talk about where to find that in QuickBooks so that you on your own could, let's see. All right. Okay, so when you are in your QuickBooks Online account, there's a few different places where you can get to the reconciliation screen. Um, I always come up to this gear up here on the top just because this is where I've just become accustomed to looking for the reconciliation module. But there's other places that you can see it. If you go into the bank feed, let's see. So if you go into like your bank feed where the bank transactions are, there's an option typically here to go into reconcile, so you can enter from here also. And anytime you go into the reconciliation module, if your books have been established for a long time, if you come in here for the first time, it's always going to give you this. Just because you see this doesn't mean your books have never been reconciled. It just means that it's the first time you're going into the module. And so from here, you just you click on get started, and then it's going to bring you to here. And how you'll know which accounts need to be reconciled is if you just click on this drop down, it will show you the different options for reconciliation, right? And so you're always going to want to reconcile your checking, always going to want to reconcile your savings. And then there's these other like inventory assets, prepaid expenses. These things would typically need to be reconciled on an annual basis. Uncategorized assets, that usually should always be zero. You shouldn't really ever have anything in there, so that account should always be zero. And then as far as any assets, the only time you would reconcile those is if you did any additions to them. So like if you have a fleet of trucks and you add an air compressor to all of them, right, as additional equipment, then you would put that journal entry in to account for that improvement to the truck, and then you could come through here and reconcile this. Always going to reconcile credit cards. So you'll see MasterCard and Visa listed here. Even if it's an American Express or Discover, we're going to reconcile it. So all of your major credit cards will get reconciled. And then liabilities can be reconciled if there's a lot of activity in there. I do recommend going through there on an annual basis and making sure that those numbers tie out to what is actually on the regulatory agencies records. So like if you have sales tax, right, and you have a sales tax amount that's owed, you want to make sure that your end of year balances match whatever the reports say for those regulatory agencies. And then of course your loans. Your loans are always going to be amortized throughout the year. There's going to be a portion of all of your payments that are going to go to principal and a portion that's going to go to interest. You should be getting a statement for that from the bank that the loans are drawn from. And then from there, you just reconcile it and make sure that the numbers all tie out and match. Most important thing for the loans is making sure that that end of year balance that's showing that you owe on that loan matches that end of year statement. We want to make sure that those two numbers are the same. Because if they're not, then that means that you've either not accounted for the interest payments that you've made, or that there's some other kind of fee or something in there that needs to be added to make sure that those numbers tie out. And so it's really important that we account for all of those, because when they're not accounted for properly, you're typically missing some interest deductions is the thing that I see the most that people do is they don't account for that, and then they lose some interest expense deduction that they could have taken that year. But yeah, so this is the module. We went over a little bit about the like what reconciliation means. Sam, do we have any other questions regarding reconciliation?
No, but there is actually an additional question from last week. Um, they actually asked, what does it really mean for books to be accurate, and what should they do if, say, for example, their bank balance doesn't match their records?
Okay. So that's an issue that we find a lot with
Yeah.
people's books that don't have proper bookkeeping in place. Um, Whenever you are looking at your end of year reports, and this is a great like little tip for every business owner in America, right? Like if you are like, well, I don't really know how to make sure that this stuff is reconciled, I'm going to show you a really easy way to look at your end of year financials to make sure that they are accurate. When you're in your QuickBooks account, if you go to reports and you go to your standard reports, it's going to bring you to this menu. And then from here, you just click on balance sheet and it'll bring you to the balance sheet. And then you're going to check last year. We're going to go to last year. And then these balances should match your actual bank statement, right? So when you are trying to figure out, are my books ready? The easiest way to tell right off the bat if your books are ready is to go to your bank account and look at your end of year bank statement, and then look at your QuickBooks account and make sure that this is set to cash, not accrual, because we're going to look, you want to look at your balance sheet from a cash basis, not accrual. And we're going to look and see, like, does this number match what the bank statement says, right? And if it doesn't match what it says, then there's a problem. The most common issue that I see in books is that they're what we call uncleared transactions in the bank registers, right? And some of y'all might be like, what does that mean? And how do I find that? So again, if you go into your bank transactions, right, and you're in this screen, there's an option to go into the bank registers here on the side. So you just click on this button. And then it'll take you to the actual ledger for the account, right? So you can see all the money going in and out for the whole year. And if you're like, well, what of these transactions have not been reconciled or cleared the bank? This is a little trick I teach my bookkeepers. If you click on this filter right up here on the top and you change your reconcile status to no status and apply, anything that's in here with no status means that it hasn't been reconciled. And if there's not a little like green box here, that means that it didn't download from the bank account, which typically means that somebody manually put that in, or it was put in as like a transfer from another account, but it's not matching anywhere here, right? Like it wasn't actually downloaded from the bank. So anytime you see anything in this column without a green little box, that means that that wasn't data that came straight from the bank. That means that it was manually put in here somehow. And typically those are the things that I see that throw off the reconciliations is the manual transactions that are put into the book. So that's an easy way to check that. And you can do that with any of the accounts. Like you can even do that with your credit card accounts. Same thing. You just come in and you tell it no status, apply, and then it'll pull everything that doesn't have a status associated with it. So that way okay, these things are probably not real, right? And if you need to remove them, if you're like, oh, this isn't real, this doesn't belong here, it's a duplicate, it's it was put into the wrong account. You want to get with your accountant or CPA and let them know that and let them be the ones to move that for you. Simply because there's ways that we can go in and very easily make the change. But if you go in and you try to change it yourself, you could you could create another issue, right? So like one of the things that I see that where people try to go in and fix these things themselves, where it creates more problems is like with accounts receivables. When people are paying invoices, you may pay the invoice in your books and it may hit this register, but then the payment comes in and gets categorized to sales, right? And so then you've got a duplicate, right? But in an instance like that, you don't want to delete the payment that you received, because if you do that, it's going to make the invoice come back up, right? The invoice will show as open, right? So we don't want to do that. Instead, what we need to do is take the downloaded payment that came in that was not matched properly to the invoice and move that back into the feed so that it can properly be matched to the payment that was already received for that invoice. So, and I know that's probably a little confusing for people that are listening, but that's why I said, if you see things like that in your books, you want to get with your bookkeeper, you want to get with your accountant and your CPA, whoever handles your bookkeeping for you, to make those changes for you so that you don't create a bigger problem in your books. But this is usually the biggest issue I see with reconciliations. And as far as like why end of year statements are not accurate is because of this. So does that answer that question, Sam?
Yes. And
Perfect.
that clears up a lot of confusion around, reconciliation and accurate bookkeeping, right?
Yes. Yes.
So those are just the questions that we have yet for reconciliation, actually.
Okay. And so I think our next topic that we were going to discuss are why clean books start with reconciliation.
Hmm.
And so things to think about when we talk about, why is this so important is, in order for you to review your profit and loss monthly and for it to be beneficial to you, your books have to be reconciled. Um, if you are intimidated or afraid of your balance sheet, if you feel like it's something that's overwhelming and you can't understand it, like those are things that you want to make sure that you sit with somebody to fully understand, like, what does that mean? Because a lot of people put a lot of focus on the profit and loss, right? Because that's the one that makes the most sense. But if the balance sheet is not correct, then your profit and loss is not going to be correct. And so we need to make sure, like, it all really begins with that balance sheet. Um, one of the biggest issues that I see with clients is when they make decisions based off of a P&L and they don't look at that balance sheet. And so the balance sheet is actually a very important report for any business owner. And if you're starting out in your company and you're new, like I would recommend that that's the first thing that you learn, right? That should be the first report that you understand and learn how to read and understand, like, what do you need to do with that to make sure that your profit and loss is correct. Because if your balance sheet is wrong, your profit and loss is going to be wrong every single time. So you got to make sure that that balance sheet is accurate. Casey, do we have any questions from the community on that topic on why clean books start with reconciliation?
Yes, ma'am. One question we keep getting is how can you trust a profit and loss if the bank account isn't reconciled? Like so say you get your profit and loss and you go in and look and the bank hasn't been reconciled. Can you trust that profit and loss?
No, no, you can't. Your balance sheet, like again, like I was saying, the balance sheet needs to be accurate in order for your profit and loss, your cash flow statement, any of those reports to reflect accurately, any of your reports really in order for any of them to report accurately, your balance sheet has to be reconciled. And the thing is, like, if your bank accounts are reconciled, then there could be errors in your accounts receivables, and your accounts receivables control your cash flow, right? Because if you're showing invoices that are open that have already been paid, and you're counting on that money to come in, in a month, but it's actually already come in, then your cash flow projection is going to be wrong, right? And so that's why it's really important that that your bank accounts are reconciled, that your credit cards are reconciled, so we can make sure that those reports populate correctly.
And that needs to be reconciled monthly, correct?
Yes, your books should be reconciled every single month. Like, there shouldn't be, some people will reconcile quarterly, for smaller businesses. Some people reconcile annually. I don't recommend annual reconciliation. I do think quarterly is a better way to go, because you should be making those quarterly estimated tax payments. And in order to do that, you have to have accurate financials. So at the minimum, you would need quarterly reconciliation, but the best approach is to do it monthly. It is to handle it monthly, to make sure that it's always correct. Because sometimes going back a couple months trying to remember what happened or what something was for can be a little bit difficult, with everything that goes on with running a business. So I do recommend monthly reconciliation.
Okay. Thank you. Well, that answers our questions for that.
Okay. Um, so I think that one of the things to, kind of think about, um, if you've ever looked at your profit and loss and you're like, well, the profit and loss says I made, 20% profit, why do I not have this money in the bank account? It's typically because you got to look at the balance sheet to see where the money really went. If you're paying any loans, if you're paying any credit card debt, if you're paying anything like that, those payments are not going to reflect on your profit and loss statement, because the profit and loss is truly just measuring the it's truly just measuring the business itself, right? It's looking at what is the activity of the business, right? How much money is coming in? That's what that income line is, right? That's what that income line means, is how much money is coming in, how much sales are coming in, right? That's what that top line is. Your cost of goods sold is measuring, how much money does it take to provide the service that's creating the income, right? So that's your cost of goods sold. Your expenses are the things that occur and reoccur regardless of whether you're open or not, right? And so those are kind of like more fixed, can be a little variable sometimes depending on what you have, how your business is structured. But for the most part, a lot of those expenses can be fixed. However, all of those pieces are just measuring the day-to-day activity happening in the business. It's not taking into account the financing components of the business and the monies that are owed that need to be paid out. Where that comes from is really from the balance sheet. And so that's why it's really important that that you start with the balance sheet. Everybody kind of goes to the P&L first, but you have to really start with the balance sheet. And then once you've got the balance sheet figured out and you understand how that works, then you can go to your P&L to make sure that that is doing, looking like what it needs to look like. So, um, things to, things to think about, right? When you're making decisions on what you want to do in this first quarter. And even, we're already in February. So like, even looking into the second quarter at this point, what do those cash flow projections look like? What does the budgets look like for the business? How much money are you going to need? What does your runway look like? All of those types of questions, those things are all very important, and they require to have accurate reconciled books to be able to determine those, what the answers are to all of those questions. Um, so I think that the next question that or the next topic we were going to discuss was good debt versus bad debt, and how smart business owners borrow, right? Like, what is the smart way to do that? Um, I think when people hear, when we talk about debt, people tend to get a little bit uncomfortable, right? They get a little uneasy when we talk about debt. So like, oh, I don't want to be in debt. But there's such a thing as good debt and bad debt. It's not all debt is not bad. Sometimes debt in a business is a good thing. It can be a positive thing, right? And I think, that's part of what we wanted to talk about in this topic. Um, if you've ever used a credit card to cover monthly business expenses, and then we're like, oh my gosh, why did I do this? Well, a big part of that is because you're not structured correctly to handle the debt service part of it. And also, if you ever find yourself in such a tight cash crunch that you're having to put your monthly bills on a credit card to get them paid, then that's a cash flow issue, right? Because if you don't have the money in the bank to cover those charges that you're putting on your card, then that means you're running out of cash, right? And so that's something that you've got to talk to your CPA, your bookkeeper, or your accountant about, because that's something that's not going to remedy itself. Like, it's not going to fix itself. A lot of people will think, well, you know, this person didn't pay these invoices this month, but they promised they're going to pay next month, and so I'm sure that it will balance itself out. Well, so what if they don't pay? Then you've got that credit card debt sitting there, and that's got to get addressed somehow. There is ways to still like work through those issues. Um, there is ways to work through those issues, but it does take planning, and it does take my light just went. There we go. It does take planning and it does take strategy in order to make sure that you can successfully get yourself out of that type of debt, that type of bad debt. Um, so yeah, that's kind of like a little bit of an overview of what bad debt is. And then, there is good debt. Good debt is when you buy revenue producing equipment or tools,
Mhm.
that's going to create more income for the company, but you may have to finance it, right? Because, like, you say you buy a $500,000 piece of equipment, but that $500,000 piece of equipment is going to last you 5 years and will produce $1 million a year for your company. That's good debt. Like, that's good debt to have, because that's a piece of equipment that's going to help you to make more money, and that's how we really look at the differences between good debt and bad debt. But you do have to plan for it. Like, that is it's not something that you can just do without having a plan in advance, right? A lot of times when people buy a piece of equipment, they think, oh, I'm going to buy this equipment and then it's going to automatically start, making more money. Well, but it might require more than just buying. And it may take like a month or a month and a half, 2 months to get it set up and implemented and get it fully working at capacity, right? And so there's just a lot of planning that has to go into that to make sure that you can withstand the debt payments that you'll have to incur before the equipment is fully up and running. And then once the equipment is up and running, how long is it going to take for you to get it ramped up to 100% production so that it's producing the $1 million a year, right? Because you buy that $500,000 piece of equipment, year one, it may not be producing at 100%. You may not get the full $1 million. You may only get $300,000 or $400,000. And so that's where you really have to plan and analyze this stuff to make sure that your company can withstand the fact that it's not going to fully pay for itself the first year, but you're going to have, like, this small amount that it's not going to produce, that you're going to have to carry that debt over. And what is that going to do? And how is that going to affect your cash? So it's just planning, right? It's just planning to make sure that you understand how it's going to affect your cash flow. You understand how it's going to, what changes you should expect to see in your income level. So that's really how you utilize good debt to help grow your business. Yes, Leslie.
I actually had a bit of a question. So, we see a lot of our clients that make purchases in hopes that they're good purchases. When a business owner makes a bad purchase, that's obviously put them in, a loan standing. What would you recommend that they do in that situation?
If they make like buy a piece of equipment that doesn't pay for itself.
Right. Or they thought it was going to be helpful for their company, and then it turns out that it's just not that.
Well, I think you have to. So again, this kind of goes where the analysis goes into play, right? Because typically when you finance a piece of equipment, you're financing it over a period of time, right?
Right.
2 years, 4 years, 5 years, whatever it is, right? And so you got to look at, okay, what are the total payments that are going out on this thing per year? And how much is it, is it, is it not making me enough money to even cover the debt payments that I'm having to make? Or is it covering that, but it's only giving me 20% over that, which I wanted to see 120% over that, right? So you got to look at that. The other piece of it too is to look at, if it was just a bad piece of equipment, which I mean, I think every business owner goes through that, right? Like, I mean, how many,
Mhm.
like I've gone through several CRMs since I've been running this company, and invested lots of money in them. And, it took a few of them for us to go through to find the one that actually works, right?
Mhm.
But sometimes like when you realize something isn't working in your business, it's not doing what it's supposed to do. It's not being efficient. You can when it comes to software, your money's kind of sunk and you're not going to get it back. Right? It's gone. You
Right.
just have to like just okay, I wasted this money
Accept the
and it's
loss.
costing me money, and you just yeah, you take the loss and you move on. If
Right.
it's a piece of equipment, there's always the opportunity to sell it.
Mhm.
Right. You can always try to sell it to somebody else who maybe can use it to make more money in their business. And you may you may make a little bit of money, you may break even, you may make some money off of it, right? Like I
Mhm.
remember back in the COVID days, like people were selling old trucks that they had for like,
Mhm.
before COVID, they were only able to get like, $10,000. And then after COVID, they were getting like 30, $40,000 for these old trucks, right? So,
Right.
that was what is it saying that one man's trash is another man's treasure, right?
Right.
So, I mean, and it's so true. Like it's so true
Right.
because, you know, there are pieces of equipment that companies have that they're like, well, this is junk. Like this isn't going to do anything. Well, it might be junk to you, but to somebody else, it might be like, oh, that's the exact thing that I need, because I've
Right.
got this thing that I do for my business. So, um, but I would say, and this goes along with anything, like any
Mhm.
decision in business, whether it's equipment, software, employees, contracts, services, when you realize it's not working and you've tried to make, you've given it the three strike, you know,
Mhm.
opportunity, to try to get it to work and try to get it right. If it's not working and it's gone, you've tried to get it to work 3 times and it's still not working, just get rid of it.
Yeah.
Get rid of it. Like don't wait, don't think about it, don't try to make it work because sometimes when you're making things work, you're actually costing yourself more money.
Right.
And so, because you're having to work harder. You're having to work
Mhm.
around something. And it's like, well, I'm having to work harder to make this thing work now than what I was doing before I ever had it. Right. So
Mhm.
if it's not helping you to grow and it's just creating more of a hindrance, right, then it's better to sometimes to just cut your ties and move on.
Sounds
And
good.
you could
I
take it
like
as a
that.
deduction.
Right.
You could offset some tax with it. If it's a
Yeah.
loss, if it doesn't, and even if you're disposing of it, right? If it's like, okay, well, this thing isn't going to work, I need to dispose of it, right?
Mhm.
Then same thing, you could write it off, disposal, like loss from disposal of equipment, you know. But
Yeah.
usually reselling it will work though.
Yeah. That sounds
Miss
right.
Mauricio, did you have a question?
Yes. So, um, I heard what you said. So I think that kind of like makes me think of, that's why it's like, it is important for the owners to invest time, time with their bookkeeping team, to provide them guidance on these kind of decisions, because we do run into those that run into something that they invested and they probably didn't need to do it because they didn't plan it.
Yeah,
They didn't get the right people looking at it. And I think that the service that COR provides really lends to that, to have that
yeah,
vision.
yeah. I mean, that's one of the things that we tell all of our customers, right, that come in for bookkeeping services and advisory services, right? Because we do the bookkeeping, accounting, payroll, sales tax, and then advisory, right? Before you buy a piece of equipment, before you take out a line of credit, before you take out a loan, like call us so that we can walk you through the things that you need to be aware of before you do it. The bank will not explain to you how your purchase is going to affect your cash flow. Like they're not going to look at that. They're going to look at, do you have the cash coming into your business to be able to afford the payments that are associated with this, right? And is your company a good risk for us to loan you this money so that can you pay it back? Like that's what the bank is going to look at. They're not going to look at whether or not it's going to do what you need it to do in your business, right? And so that's what we do is that's what we look at. If somebody comes to me and says, I want to buy a new insulation machine for my company. I'm going to say, okay, well, we're going to buy a new insulation machine. What else does that involve? Are we going to have to buy a trailer for it? Is the truck that you're going to put it on? Does it have the hitch? Is it strong enough to be able to pull this thing? Well, it's an old truck. Okay, well, how long do we think that truck is going to last before it's going to burn out from pulling this machine, right? Before you have to replace it. What's the timeline of it? Okay, the timeline is probably a year. You probably got another year on this truck. So how much is it going to cost to replace that truck? So in a year, we know that in order to keep this insulation machine up and running, we're going to have to finance a new truck for the machine to keep it moving and to keep it going around. Like these are all the things that we look at with our clients when they make major purchases is, what is the overarching impact going to be on your business after you make the purchase? And we can do this with anything. Like we can do this with equipment. We can even do this with services, right? Like we can show you, even with our service, right? Like we show clients like how they benefit from paying us for what we do, right?
Yep.
Because that's the whole purpose of it, right? There's a return on your investment when it comes to working with us, whether it's, being able to save you money on your taxes or find more efficient ways for you to run payroll. I mean, we had a client just yesterday that we were working with that's been running payroll manually for years, right? Doing it for years and years. And we introduced a new option, enhanced technology, more streamlined processes. And he's probably going to save more than 50% on what he's been paying to do this for years, right? And it's going to streamline his operations. It's going to make his life easier. It's going to make the employees' lives easier. It's going to make the contractors' lives easier. Like it's going to benefit across the board, right? So the return on working with us is coming from not just tax savings, but also dollars and the way he's handling and managing payroll, right? And then there's the opportunity cost as well that he's going to see for not having to spend so much time on that stuff. Like a lot of it's going to be automated. And so it's going to give him back his time. And like I said, these are things that we can do not just with payroll, right? We can do the same kind of analysis with like a marketing service, right? If you have a marketing service, okay, let's take a look at your marketing service. How much money are you spending on that? What kind of return are you seeing? How is it affecting your revenue? How many leads are you getting a month? Okay, when the leads come in, are they qualified leads? Are they converting into sales, right? How much time are you having to spend with the marketing team going back and forth and approving ads and approving what they're doing? Like how much of that are they providing to you? And are they providing you a return on your investment analysis on a monthly basis so you can see how your ad spend is affecting your top line revenue, right? Or are you having to do that yourself? And so we look at all of these things and again, like I said, with every service that you have, like we can do this type of analysis for you to determine, what you can expect from it. And sometimes the benefit is not necessarily a cash benefit. Like it's not necessarily, it's going to save me money. Like sometimes it might cost you more money, but it's going to give you back time, and sometimes getting back the time is more important than spending the money, you know? So yeah, I think that was a very long-winded answer.
It was a good answer.
We were
It was
talking about
true.
business debt and we started talking about return on investment analysis. So any other questions on good debt versus bad debt or equipment purchases? Do you guys have any other questions or any questions from the community?
Not that I see on my end.
No? Okay. Um, I think that there is a reoccurring theme in a lot of these topics that we're talking about this week, and a big part of it is planning. A lot of people are like, what does it mean? What does tax planning mean? What does that mean? Well, tax planning isn't just planning your taxes. Like, yes, we're going to look at your taxes, but at COR, we go beyond that. We don't just look at your taxes. We look at everything. We look at how you're spending money. We look at the percentage of income that every single line item is costing you, right? Because if I'm looking at your total cost of goods sold and your total cost of goods sold is 80%, I'm going to tell you, like, this doesn't really look right. Like, let's look at your pricing structure and make sure that we're accounting for all of these expenses in the way that you're pricing things. Anybody that would say I haven't looked at my pricing structure for 3 years or more, like book a call. Like let's go over really quickly just some basic things that you can do to make sure that your pricing structure is set correctly. Over the last 5 years since COVID, the world has changed immensely between wages
Mhm.
paid out to employees, costs of insurance, just the cost of doing business, right? Like it's gone up significantly from pre-COVID days. If you haven't looked at your pricing structure in that long, like call our office. Like I can give you a few pointers and key tips that you can start with to make sure that your pricing structure is set up so that you are able to reach those profit margins that you're trying to get to. Because if you don't look at that, then then your profit margin is just going to shrink over time. Because as we know, like inflation, cost of living, cost of employees, cost of insurance, cost of everything is going up. Like nothing's going down. Um, and so it's important that we look at all of that. And again, that's what makes the planning services at COR different than maybe other firms, is that we don't just, yes, we look at the tax piece of it, but one of the things I always explain to clients is that your tax experience is 100% dependent upon your bookkeeping. If you do not have good bookkeeping and accounting, your tax experience is not going to be pleasant. It won't. Because your CPA that's looking at your tax return once a year is not going to know all of the things that may have, could have, and should have happened throughout the prior year. And even at that point, by the time your CPA gets to it, it's too late to do anything, right? Like you're being reactive. So being proactive, planning services, paying for the bookkeeping, even if you don't want the monthly bookkeeping, like the quarterly financial review services that we offer, like that's a huge value for all of our clients, just because it allows us every quarter to go through, if we don't do their bookkeeping, to make sure their books are correct and up to date, to make sure that financials are in order, right? That the bookkeeper or whoever's maintaining it has been doing it the right way. If there's anything that needs to be corrected, that it's fixed in that quarter. And then we can tell you right there and then, what did the first quarter look like and how is that going to affect the subsequent quarters from there. So it is important to have those reviews. And again, we do that. We do all of those things. So you just call our office, 512-337-1070, and Casey will answer the phone.
Mhm.
And she'll be happy to book you some time on my calendar so we can chat. You can also use the book a consultation link that Sam is going to post in the chat and on social media. So if you would like to book some time that's convenient for you for us to talk about your business, talk about any of these good debt, bad debt topics, pricing structure, looking at, providing you with some information on that. Be happy to do that. So,
I
um,
just want to say something, Miss Brandy. I know with Core, I'm not too sure if other companies do it, but I know we do monthly bookkeeping meetings with our clients that we do bookkeeping for. So we always, if we do have a question within that month, we make sure to ask it within that month. So there's no issues 6 months down the line where we ask something.
yep. We do month-end close services by the 15th of the month. So
Yes.
typically, like within the first week, we're asking questions to the clients and getting clarification on things. And the goal is always to close the month prior by the 15th of the month. Um, so that's the service level that we offer. I'm not sure what other firms offer, but that is what we do. And yes, the bookkeeping meetings are important for us. And not just for transaction clarification purposes, but just so that we can like talk to the customer and know what is going on in their business, what is going on in their life, right? Because life happens, like things come up, you know, babies, people have babies. There's been like a huge slew of babies being born in COR and with all of our clients. Everyone's being fruitful and multiplying. It's great. Um, but but yeah, things happen, things come up, extra distributions are needed sometimes, money put into the business has to happen sometimes. The need to hire comes up, all of these things. And it's important for whoever's handling your bookkeeping and accounting to be aware of what is going on so that we can properly advise you. And that is a big part of those bookkeeping meetings, is just to sync up with the client, find out where they're at, and to help them navigate whatever it is they're going through in that time, with clarity and confidence, knowing that, they've got good financials and good professionals that have financial professionals who have your back to help you make those decisions. so you can reach your long-term goals. So, yeah. Any
Thank
other
you.
questions?
No, ma'am.
Okay, so let's talk a little bit about debt versus cash flow and why profitable businesses still feel broke. And we talked about this a little bit, right? It's the whole like, and I think the easiest way to understand this is when you think about like your personal finances, right? Well, I have my day-to-day bills that I pay, right? I have my rent, I have my utilities, I have my groceries and my gas, right? Those would be considered your household operating expenses. This is what it costs to run my household, right? Not too different than it is a business, right? It's kind of similar. But when you're running your household, when you make purchases, right? Then you are adding debt, right? And so then there's your monthly debt payment that you have to pay, right? And those debt payments can eat up the extra money that you have coming into your household, right? And so same with a business, right? Your business may be profitable. You may be making lots of money on the revenue side, but you just have a lot of debt. And the thing is, if you have a lot of debt and it's not like revenue producing debt, it's bad debt, right? What we call bad debt, there's ways to handle that. There's a lot of different things that you can do to manage that, to make sure that it doesn't like eat up all of your cash. Because ultimately, that's really where businesses end up failing and finding themselves getting in trouble is that they have too much debt and not enough cash coming in. Um, and so that's a big reason why a lot of companies that have a lot of, that are making a lot of profit still feel like they don't have any money. That's exactly why that happens. Um, I think that when we talk about profit, don't lean on that. Don't lean on the fact that my business is profitable. Like, talk to your accountant, look at your balance sheet. A great question to ask is, what are my total debt payments per month? It's a great question to ask your CPA or your bookkeeper. Can you tell me what is my total debt payments per month for my business? Because that right there will tell you, okay, well, this is going to automatically come off the top line of my revenue. Like, I need to deduct this right off the bat. Like, this is coming straight out of the income that I'm taking because I have to pay this debt, right? I can't not pay it. So that's one of the things that is important to look at. And again, all of these things, like all of these views and all of these processes that we're talking about, all the different reports that we're discussing, all of these things are things that you really want to learn, right? And my advice is to learn it from the people that you're working with. Um, and if you don't have somebody that you're working with or that's not really able to provide that level of service, like call our office, reach out to us. We're happy to help you in any way we can. We have these free webinars, right? You can even post your questions here if you want, right? We're happy to answer them. But I just think that part of it, like cash is going to become is a squeeze right now for everybody. I would say like the majority of business owners that I know are looking for some kind of financing options, whether it's a line of credit or just a loan to buy a building or equipment, right? A lot of people are out looking for money right now to get that stuff done. And the banks, I think, are loosening up the reins a little bit on getting that cash out to the general population so that we can, like the economy can keep moving forward and grow. But just know that when you're taking out debt, if you are taking out bad debt, right, debt that's not going to be revenue producing, that's not really going to help you to grow. It's not going to help you to scale. The revenue producing debt is what will help you to grow and scale. And there's a mix, like there's a balance between the two of them, right? That you can do that will still allow you to scale and grow. You just won't grow and scale as fast as maybe you want to, but you still can do that. But these things are all just important to discuss with your financial professionals, right? The people that are looking at your books and that understand how the numbers in your business are working. Yes, Miss Mauricio, I think you have a question.
Would it be a good opportunity to sit down with the bookkeeper, like you mentioned, and then kind of go over, or even for yourself for that matter, like when you're thinking about those things, to maybe look at the non-value added activities, even if it's within your home or in your business, what's a non-value add to get rid of
Mm-hmm. Yep.
versus something that is required, but there is a lot of I know a lot of companies, they have these NVAs, and it's called non-value added activities that are not really necessary, and they could slim on those.
Yeah.
Might be helpful.
Yeah. I mean, that's part of like the Six Sigma principles, I think, is like lean
Hmm.
accounting, right? Like running lean. If it's not adding value, then don't do it. Now, something to keep in mind when we talk about not adding value is you have to take into consideration the world that we live in today, right? And if you want to attract the best talent into your business, then you have to invest in them. You are not going to attract top talent into your company if you are not pouring back into people. People don't want to stay stuck at where they are, right? So you have to invest in your employees. When you go to hire somebody as an employee, you have to look at them as somebody that, like, you almost have to look at it as a stock option, right? When you hire someone, you're bringing that person in, you see their prior performance, also known as their resume, right? The resume tells you like what they did prior, what their prior performance looked like. You have to look at, what their plans are. It's the purpose of the interview. The interview is vetting, right? Just like you vet a stock and you look at it and you say, well, what has it done in the past? What are the future plans for this company, right? What are they planning to do with it? You're vetting that stock. You do the same thing with your people. You vet your people. You look at them and you say, okay, you know, what is, yes, I see what you've done. Tell me what you want to do. What does the future look like for you, right? And if you have a person that's like, well, I want to grow, I want to learn, I want to do more. My goal is to be a director. My goal is to be a VP. My goal is to be my own business owner one day. You know, you want to look for somebody that has goals. And then when you find those people, invest in them, train them, teach them, pour the money back into them. Some people will say that training and growing your employees is not a value added thing, but it absolutely is. I don't agree at all that like that training is a waste of money. Training is the best use of your money when you talk about people. Because the more they learn and know, the better they're going to be able to serve your customers, the better job they'll be able to do for your company. Same thing with software and technology. You'll hear some people say, "Well, I've had the same software for years and it works fine. I don't really see a need to change." Well, but maybe if you did change, right, and you did spend a little more money on that, you would improve your processes. Where it's taking 10 people to do a job right now, maybe you would only need 5 people, which means that the 10 people can probably do the job of 20, right? Which means that you could double the size of your business. And so there's just a lot of things that I think in the past have been looked at as non-value add for a company, but times have changed significantly. Investment in software, investment in your people are probably the 2 top things that I would be putting money into right now. If I mean, that's what I do in our business, right? We're looking at technology. We're looking at how AI can help streamline processes in our firms, looking at how to train and teach our current staff to keep them developing and growing in their roles and in the roles that they want to be in the future. All of those things are important for our firm, and I encourage all of my clients and anybody watching this, right? Invest in your people, invest in them. Like just, put the money into it and watch them grow because they will. People will grow. They will. And it also makes them know that like you're invested in them, as your employer, like, you know, and you should want to invest in them because kind of like I said, they're like a stock. You put money into it and then you watch it grow, watch it multiply. I will say with your employees, like make sure that the trainings that you invest in for them, though, that you vet them, right? That you review them as the owner and make sure that it's going to actually help the employees reach the goals that they want to achieve. There's a lot of people out there that make a lot of promises about training and learning and adding production, and your people are going to be incredible, and we're going to come in, it's going to change the world. The whole company is going to change. Just remember, like those big promises of delivery, get them in writing. Get them to put it in the contract. So that way if they can't deliver on it, you can get some of your money back. But and anybody consultants that you work with, get your contract, get it in writing from them. What they're going to do, what their benchmarks are. How are you going to measure them? How are you going to measure their success? Because their success is 100% dependent on your people, and so just making sure you have all that stuff in writing, especially when it comes to training, because there's a lot of self-made YouTubers and even companies, entire businesses who um have training modules and things like that they put out to the public that make big promises, but they don't necessarily always deliver. So just make sure that one, you're vetting and checking, ask for references. Ask for references. Hey, you say you've done this for another company before. Send me 3 people that you've done this for so I can call them and talk to them myself and see how much it grew their business. Ask for the referrals. And it doesn't even matter how big the company is. Like you could probably go to a company like Salesforce and say, okay, Salesforce, you're going to sell me your CRM and you're telling me that your CRM helped to enhance efficiencies at, thousands of firms across the United States. Okay, send me 3 of them that I can talk to. I want to talk to 3 of them and see how it affected them. Send me 3 people. I mean, if somebody came to us and asked us, hey, can you provide me with referrals for what you've been able to do for a startup company in 4 years, I have people that I can have you talk to. I have clients that'd be happy to talk to you to tell you what we did for their business. So any kind of company out there that's making a claim that they're going to be able to improve your business, improve your tax situation, they should be able to provide you a referral as well that you can meet and talk to hear firsthand how that service impacted their business. Shouldn't just be Google reviews and Yelp reviews because anybody can put those out there. You can buy
That's for
those.
sure.
We don't buy them, but you
Yes.
can.
No.
You can buy them. We don't buy them though. Uh, but yeah. So anyway, any other questions, guys? Any other questions from community or anything like that?
No,
Any
ma'am.
questions that y'all have? No? Well, thank you. I want to thank everybody for joining us today. I hope you got some helpful information out of this. If you have any specific questions that you'd like to ask offline, you can always click on the book a consultation link that Sam has posted in the chat and on social media and everywhere. Click the link and book a time that's convenient for you. You can also call the office 512-337-1070. Casey will be standing by waiting to take your call and to set up a consultation with you one-on-one time. If you are an accounting firm or CPA owner that would love to just kind of collaborate and connect, do some networking, professional networking, and just talk about business, right? Talk about what we're doing in the world and new technologies and all these things that are coming forth. AI is going to be a huge game changer for every tax and accounting firm in America. It's going to happen. It's those of us that are jumping into that now that are going to see the most benefit from it. Those that wait are going to be left behind. So if you're an accounting firm owner and you want to talk about, how AI is going to affect accounting firms in the future, would love to get some one-on-one time with you and talk with you about that. We do have some exciting announcements that we're going to be rolling out over the course of the next couple of months of a new business endeavor that I'm undertaking to help grow and scale small to mid-sized accounting firms, solopreneurs, small accounting businesses, small bookkeeping businesses. So if it's something that interests you, please feel free to reach out to our office and Casey will get that on the schedule with us. And yeah, thank you for watching and joining us today. And next week we will be back here again to do another topic. I don't know what it's going to be yet, but I'm sure it's going to be good. So everybody have a blessed day. Take care. See you next week.
Bye.
Bye, guys.
Bye.